The mainstream narrative this week is unanimous. AI is hitting a wall. Big tech is rotating into custom silicon. The semiconductor trade is dead. That's the cover. The forensic data says the opposite. This is GreenCandle. The internal plumbing tells a different story than the chart. Today we're looking at NVDA, what the chart is hiding, and the higher probability trade it sets up. Last week was two markets in one. Monday opened with a violent surge to a fresh all-time high at $216.61. Then 4 straight sessions of bleed. Friday closed at $198.45, an 8% drawdown in 4 sessions on a mega cap. To average retail, this looks like a broken trend. To the forensic trader, it's a hunt for liquidity. Friday's low at $197.12 cleared the retail stop zone. That's not random. Mainstream says ChatGPT is stalling. Meanwhile, OpenAI just shipped GPT 5.5. Codex broke every industry benchmark in the same release window. They're 100% reliant on NVIDIA hardware. Either the stall narrative is wrong or the metric being measured is the wrong one. Mainstream says custom silicon is replacing NVIDIA. Google's TPU and Amazon's Trainium are real, but they handle 5 to 10% of global AI compute. And critically, they don't run on CUDA. For the other 90% of developers, NVIDIA isn't a chip, it's the language. Mainstream says rotation. Forward-looking markets are realizing AI is significantly larger than just Google or Amazon. The current rotation out of NVIDIA isn't permanent. It's a breather. And the reversal is timed to a catalyst 18 days out. Here's what the data says. An 8% drop in 4 sessions on a mega cap leader is statistical mean reversion territory. The snap zone is $206.41. The resistance that typically gets retaken. Friday's selling printed on lower volume than the prior down sessions. That's exhaustion, not panic. The aggressive sellers are tapped out. Friday's dip cleared retail stop losses. That's the trap signature. Capitulation at the lows isn't randomness. It's the fuel for the institutional reversal. Here's what the gamma profile is showing. NVIDIA is holding above the zero gamma floor at $195. Above this level, dealers are long gamma, which means they're mechanically forced to buy the underlying as price drops to maintain neutrality. The dip isn't unsupported. It's actively cushioned by dealer hedging. Here's what the dark pool is showing. Friday's DX print, courtesy of Titan Flow Intelligence, was 45.14%. That's the institutional accumulation threshold. While retail was selling the 4-day bleed, institutions were absorbing the paper at scale, hidden in dark pools. The plumbing is one direction. The headline is the opposite. Here's what Max Pain is showing. Monday's Max Pain strike is $207.50, well above the current price. The market is mechanically incentivized to pull price toward this strike before OPEX. That's not narrative, that's mechanic. Here's the trade. 18 days to print. Asymmetric setup, defined risk, specific levels. The entry. Wait for Monday's first 15-minute candle. Buy the close above that high. Confirmation comes when a 1-hour candle closes above $200.50. That's the call wall crumbling. The vehicle. June 5th, $215 calls. That captures the Vega expansion into the print and provides post-earnings protection. The trap door. A 1-hour close below $196.50. That's structural invalidation. Scale out at $212.50. Final target is $216.83. The prior all-time high. A full retake. The chart shows a breakdown. The internal plumbing shows a coiling spring. We're trading the dealer's need to re-hedge as price drifts back toward the max pain magnet. GreenCandle. One last note. Nothing here is financial advice. Options carry total loss risk. Theta decays. IV crushes at the print. The thesis is data-driven. The execution is yours. The stop loss is non-negotiable. Do your own research. Subscribe for forensic flow reads on tactical setups. Drop a comment with your read on the trade.